Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 159th CP program organized by AASB of ICI. As you all are aware that AASB is in the process of knowledge dissemination activities relating to all the auditing aspects, and AASB has covered all the sectors as well as all the standards during this year. And today's 159th CP program organized by your AASB. Honorable Chairman and Vice Chairman, sir, both are stuck up in the one of the another meeting. So I'm taking this liberty to start this today's webinar. And we all are aware that today's topic is again very relevant film media as well as the digital content sector, television, film media and digital content sector. And in order to tackle this very important sector and very new sector, which is required, auditors are required to know about these certain intricacies while auditing this sector. So in order to tackle this, we are having with us from Mumbai, C. Manish Sampatji. So on behalf of AASB of ICI, I give you warm welcome, Manish Sampatji, on behalf of AASB of ICI. Welcome to you, sir. And we are having with us two from our Chartered Accountant fraternity, two moderators, CA Gaurav Bhatia ji and CA Gaurav Mani. I welcome both of the moderators. Gaurav ji, welcome to you on this AASB platform. Gaurav Mani, I also welcome to you in this AASB platform. I also welcome all the participants of today's webinar. So before we formally start, I request Gaurav Bhatia ji to please start the proceedings of today's webinar. Over to you, Gaurav ji, please.
Thank you. Thank you, Anandji. So good evening to our esteemed participants. I welcome you all to today's webinar organized by the Auditing and Assurance Standards Board of ICI on a very relevant topic of key considerations in the audit of television, film media, and digital content sector. At the outset, I welcome and thanks, in fact, CA Sanjeev Singhal ji, who's the chairman of AASB of ICI, and CA Vishal Doshi ji, vice chairman of the AASB of ICI, for this opportunity. They are not available today, but I'm remain thankful to them for this opportunity. I also welcome our esteemed speaker for today, CA Manish Sampatji. Welcome, Manish ji.
Thank you.
So I'll be the moderator for today's webinar along with CA Gaurav Mani, who is going to be the fellow moderator with me. So, in fact, delighted to see that a lot of people in the audience are joining as we get the numbers across different corners of the industry. Maybe luckily, there are less budget proposals today. So a lot of our fellow CAs are able to join or maybe able to spare time. Otherwise, 1st February is a hectic day for all the chartered accountants. But yes, it's an interim budget, so was expected as is. All right, so today's topic is of utmost importance and very apt considering the ever-evolving landscape of entertainment and media. The audit function, as we all know, plays a crucial role in ensuring the transparency, reliability, and compliance. So today, we will delve into the unique challenges and opportunities inherent in the auditing the organizations within the television and the film media sector. So as we all know, with the rise of the digital platforms and with the social media or the digital content becoming one of the very, I would say, evolving industry, and in fact, with the changing technological advancements and the consumer preferences, it on one side, it presents a lot of opportunities and possibilities. At the same time, for the auditor, the complexities become very high. And today, our goal is to explore the key considerations that as an auditor, you will have to keep in mind when you are navigating or performing any kind of audit in this dynamic sector. In fact, our distinguished speaker today, CA Manish Sampatji, bring a wealth of experience and insights to the table with him. And he's going to provide his practical perspective and addressing the nuances of the audit processes in this sector. In fact, before we commence, I would like to extend our gratitude to the AASB of ICI one more time and CA Sanjeev Singhal ji and CA Vishal Doshi ji for their support in making this webinar series possible. In fact, this is the 159th seminar of this overall CP series. And I believe their commitment to promoting knowledge and excellence in professional community is commendable with the way these webinars have been scheduled. I encourage active participation from all our audience today. Please feel free to ask any questions, post it on the chat box, and we will come back and we are going to address it in the end to the speaker. Now, without further ado, let's dive into the world of the auditing on television, film media, and digital content auditing. I hope you find this webinar both enlightening and valuable for your professional journey. Now I invite CA Gaurav Mani to give an introduction of our speaker, CA Manish Sampatji. Over to you, Gaurav.
Thank you, Gaurav. Thank you so much. So I welcome CA Manish Sampatji. CA Manish Sampatji is a commerce graduate from Bombay University and a chartered accountant. He has been into practice for more than 27 years. He has joined CNK and Associate LLP as a partner by merging his individual practice. Currently, CNK and Associates LLP has a total staff strength of 750 plus and has offices in Mumbai, Baroda, Chennai, Bangalore, Ahmedabad, Delhi, Gift City, Pune, and Dubai. CA Manish Sampath is a part of audit and assurance practice of CNK and specializes in attestation functions of banks, NBFC, foreign multinationals, startups, and new age business in the service sector. He handles statutory audits of several large banks, listed entities, foreign companies, large private companies, eminent law firms, and charitable trusts. He handled the audit of the Reserve Bank of India during the tenure from 2013 to 2016. He has been a part of many study groups and subcommittees under AASB, ASB, and other committees of ICAI. He is a contributor for the revision of guidance note on bank audits and is a part of the expert panel to address the queries of members regarding branch bank audits. He is also a part of the study group formed by the ESB of ICAI for the upgradation of existing accounting standards to bring them nearer to the IND AS. Currently, he is also involved in developing the study material for the Center for Audit Quality initiated by the ICAI. He is involved with several ICAI committees and initiatives by ASB, AASB, peer review, FRRB, FRG, CAQ, etc. CA Manish Sampath was the president of the Bombay Chartered Accountants Society in the year 2019-2020, and currently he is the chairman of Accounting and Auditing Committee. He has co-compiled the publication Mandatory Accounting Standards for Published Accounts, jointly publicized by BCAS and CCH. He is the honorary secretary of the Audit Committee of the Cricket Club of India Limited. He is a past managing committee member of the Western Indian Automobile Association of India. He is an active Rotarian and an honorary treasurer of Rotary International District 3141 in 2022-23. He was a faculty at the HR College of Commerce and Economics for many of its professional courses. He has delivered lectures on various topics of professional interest and practice management. Now I'd like to invite CA Manish Sampath to enlighten us with his words of wisdom. Thank you.
Thank you.
Over to you, Manish.
Thank you. Thank you both, Gaurav. First and foremost thing, it's always a pleasure to speak to our professional brethren from the Institute platform. And of course, just to repeat what earlier was said also, it's really commendable the work that the Institute is doing, and specifically the AASB on holding such specific programs relating to industry. So naturally, when it is relating to industry, definitely these programs are actually targeted to be more practical and which will help in your practical practice, even though if you are either from the auditee side or from the both sides of the either the auditee or the auditor, it will help you because these are actually practical issues that have been faced. And initially also when Anilji was coordinating with me, I was a bit busy because of the Q3 limited review. So I told him, I'll be free in the, last week of, January. I didn't know that 1st February, actually, I didn't realize at that time that it was the budget. Had it been a full-fledged budget, then we would have hardly had any any listeners to our topic. I don't know now how many speakers we have, but as Gaurav said that, yes, it was just an interim budget, sort of not a full-fledged budget. So therefore, and plus, I believe there was nothing major announcements besides policy adjustment. So that is with these words, I think so. I'll just share my presentation. Just give me a minute. Is the presentation visible?
Sir. Perfect, sir.
Yeah. So yes, key considerations, or I would say, key audit matters that accustom or we face during the audit that we do of film, media, or television, or in so-called, it's loosely called the entertainment industry. When we talk about entertainment industry also, so what I will be, just to start off with is just a disclaimer that these views which are there are my personal views and not necessary views of my firm or the institute. What is installed today for, for us today, what I have planned is for the next maybe 90 minutes or so. I will just give you a brief. Initially some time I will spend on what is the industry background, because it is important to know how the industry works, what is the nuances, what are the dynamics, challenges in the industry that is faced today. So based on that, I will be just spending some time on giving the background of that particular industry. Then what are the risks associated with that industry, what is the future outlook, and along with risk also it comes is opportunity. So why this particular sector, Anilji had briefly mentioned to it that why it is a promising sector, why it is a growing sector, it's contributing to the GDP and why it's moving forward. So that I will touch upon. Then what are the types of sectors that I'll be covering today? That is there. Then of course the audit procedures, how we will follow. Then regarding some accounting treatments, particularly which is very peculiar to these sectors, I'll be covering. Then after that, I also, have some synopsis of major or significant accounting policies which are disclosed by listed companies or which are available from public platforms. So that I will be covering. And then the key considerations, the practical issues that one can face. Though there are case studies, because it's I've put it, but case studies I'll be circulating separately. I don't think we will get time today to discuss these case studies, but this is what we have done it. But all the case studies are based on actual problems or actual issues that I will be discussing during the next 75 to 90 minutes. Now, first and foremost thing, yes, the industry diagram. Why is it important? This particular industry or sector that we are talking about, which includes production house, which includes television, digital media, film entertainment. Also, I have covered some gaming, online gaming, issue that the gaming sector is facing. How what audit procedures need to be taken. Also for maybe sports event management companies, etc., etc. So this is the full gambit that we will be covering. Of course, print is mentioned in this particular site, but I have not covered any major issues as far as the print media is concerned. So friends, as you can see that this is from publicly available data that today the size of the sector by 2025, size of this sector is going to reach about almost 3 lakh crore is going to be the size of this particular sector. And over the past couple of years, it is growing at a healthy, compounded growth rate of approximately between, 15 to 20%. So that is the strength of this particular sector. Initially, we all, when we understood, about this sector, or when we were talking about, what things initially come to our mind is the old, brand television companies, cable companies, film productions, and the movie distribution and the movie exhibition company, that is the theaters, etc. But now when we move forward, I mean, now what is there? The new things. The OTT has come, the gaming companies, the social media influence, the social media, digital media, etc., etc. Live events, sports events. These are the all new age sectors that have the rising sectors which are there. So if you go to see today, my assistant who was helping me making this presentation also told me, sir, why don't you say, why do you use cable TV? I said I had cable TV till about 3 months ago, and then I have not renewed it because everybody is looking at the content that they watch. So we have a TV at home, but nobody is watching the normal traditional, the cable TV, etc. So that's how everybody is moving. I mean, if I want to see some channels, I have, different means, OTTs, mobile phones are available. Now, why how this important, what is the importance of this sector also, what has the government done to promote this sector? First and foremost thing, it has relaxed the FDI norms. So I think so, accepting in the news TV where there is a FDI norm, otherwise everything else is opened up, it's 100%. only I believe in the news, it is capped at 26%. So it has opened up. So foreign funds can invest. The foreign investors are there. So today we have all the, the international companies, CNBC, we have Disney, etc., Star, Sony, all operating in India. So that is one. Second thing is the government has also facilitated a single window, a nodal office for getting all the approvals for movies. That is another thing. Also, as far as capacity building, also the government has made this, the gaming and center of excellence in collaboration with IIT Bombay. So along with that, also it has made capacity building possible. And next most important thing is that there is potential to grow. There is huge potential in this particular industry. So far, if you would see this industry till a decade ago, what was loosely, a lot of informal sector, it was a lot of cash transactions, a lot of, it was not formalized, this particular sector or this particular industry. But corporatization has happened. There has been industry houses which have big time invested money. So it has become a very formal sector, and or the old practices have died, and therefore this can be seen also. There is consolidation in the industry right now. Smaller players are being, taken over by larger, stronger players, because this requires a lot of capital infusion and a lot of funds are required. So we can see that initially it started, I think so, about 10 years ago when UTV was taken over. Then the current Sony Z that is happening, of course, as things stands today, that's not happening, the merger. But yes, that it was on the cards. Then the Disney Star Alliance is there. And finally, Viacom 18, the tie-up or, the binding, non-binding understanding with Disney for its merger is there. Plus, we had the merger of the Inox PVR, creating almost like a virtual monopoly as far as the film exhibition is concerned. So yes, as I said, government has made a lot of push. These were the budget announcements last year that the government has made. And you see, even the state governments are facilitating, film institute. They want film studios to be built, because it brings about a lot of, revenue, employment, indirect benefits to the state and the people at large. And it is attracting international investors. Most importantly, now I think so. This is was the background, but now I think so. I'll be covering, the audit points. How basically how we will address certain challenges, certain risks which are involved in this particular industry. So first, to start off with, what are the risks that industry has? First and foremost thing, yes, with the data protection, privacy, how the intellectual property rights are preserved, how strong the legal system is to protect intellectual property rights, the copyrights which are there, how laws they are there. So therefore, first risk that this industry faces is, the cyber liabilities, or this, the regulative risk which is there. So when an auditor definitely starts an audit of this particular sector, he has to keep in mind that these challenges as far as data protection. So not only he has to be abreast with the, the auditing standards or the audit procedures, or he should be strong enough in his execution of audit. But besides that, he will have to know or require the, the challenges or the environment in which the current industry, or the environment within which the sector is currently expanding. Then it is a very, sector is also, risk. It's a very risky as far as emotions and sentiments are concerned. Maybe some, digital content, or maybe some production or entertainment, some content comes up with some dialogue, or with the heroine, whatever the color of clothes she is wearing, etc., etc. So it becomes quite sensitive. So that is another risk, and how that impact would have on the business or on the going concern, and particularly, the business, and how it will impact the audit procedures need to be amended to cover these type of situations. Then since this is an upcoming sector, a lot of industry players are there, a lot of people are engaged in this particular sector. So therefore, there is also, very unique to this industry is the subcontracted services or the line production services, which is called the third party liability. So therefore, maybe there is a television company and it has outsourced, or maybe a production house is not a telecaster but is just making a serial TV serial, or is making some content and selling it or providing it to the television broadcasting company. So those type of liabilities. So in case, suppose if the production house has not complied with certain labor laws, what would be the liability on the company who is broadcasting it or who has the right to use the content, etc. So those will have to be taken in mind. Even though, I mean, in any capacity, though you are even though you may be an auditor of the broadcaster or you might be an auditor of the production house, etc., both ways that will be there. Then again, there's a very dynamic and volatile geopolitical environment. There is a social backlash. Say for example, now gaming companies there, and as was mentioned, and from experience I can say, that the negative impact of just now, games, whether it is involving money, betting, etc. But from experience we can say that we do a lot of audit of a lot of banks. And just recently, since the past couple of years, there is a huge, hike or a huge increase in the frauds that are happening, small ticket frauds that are happening in the banks. And when we spoke to the risk committees and when we, do an assessment and we speak to the internal auditors and the management of the company, what directly we've been told is that yes, there is a lot of, frauds, small ticket frauds conducted by fraudsters because and youngsters more particularly, because they are hooked on to two things. One is because of the stock market buoyancy, so therefore a lot of people are trading without understanding and losing money. And second trend was on games, that a lot of money they are putting and they are losing, and they require this cash flow to for the addiction sort of that they have. So therefore there is an increase in bank fraud. So this is a proven this thing, and we have statistics and on that particular thing. Of course, again, the other sector, as I was initially telling you, that this particular sector was very fragmented. It was not a very organized sector. It was more dominated by unorganized sector. Only in the past decade or so now, we have big corporates investing money, big corporates, coming and having a more corporate culture, increase in the governance structure, etc. We see. But so far, it had a lot of issues as far as cash economy, parallel economy, etc. So as an auditor, when you do, you have to keep aware of these type of risk and challenges in the particular sector. And uh, next, I believe also is, of course, some people would not believe it, but yes, the people who are driving this sector are the creative people. And the creative people are usually, it is observed, very few people have got a talent, creative talent also, who do production and who, understand music or photography, etc., who write good stories, dialogues, etc. And plus, they are very well financially literate, or they know the accounting, etc., because they understand the creative part of it, but they don't understand the regulations, what income tax, GST, etc., compliance is there. So therefore these creative people are running, they're doing the creative work, and then there are these professionals. So therefore this type of balance also is, so this is also giving increased risk. Because if a promoter is there and promoter is more creative, he will look after the creative part of it only, and the legal compliance and the regulatory compliance, he will leave it to the accountant, who might not pay more important, because making money is more important than all these compliances. Again, and lastly, but not the least, I think so, this particular sector is ever changing. Newer technologies are coming, emerging platforms are coming out, and more complex revenue models, etc. These complexities are increasing. So these are the general risks associated with this particular industry. And when there are risks, I believe, friends, that there are equal opportunities. So what are the opportunities right now? The sheer size, I think so, of this particular industry, even the my assistant who was helping me with this production has got some figures, a lot of figures she had, but I'm not producing because otherwise it would look more like a presentation on the industry rather than the key audit issue. So what she tells me is that as of now, there are about 565 million homes with rural penetration where there is, TV has reached the, the rural public, homes, rural homes. So therefore that, and plus with the advent of 5G communication, the internet speeds becoming faster, more international players coming, the younger generation, higher disposable income, they are ready to consume more, consume on entertainment, consume on films, etc., is giving rise to have this sector as a sunrise sector. And a lot of opportunities is coming also because of consolidation and formalization in this sector that as I was saying. Now, uh, what these are, some of the industries that in this sector that, whenever we have taken, some audit issues or some key audit issues in the presentation, these are the various sectors that we have kept in mind. Though maybe it might be possible that when we talk about issues, all issues might not be covered from all industries, but also whatever we have given is just a suggestive or examples which are given from our, either experiences or discussion with fellow professionals, etc. And maybe it might not be the only issues which are there. And similarly, when we cover the audit consideration, these are suggestive or few examples that we give. And the audit considerations or audit procedures that I suggest here should not be construed that these are the only ones. These are just a few examples for discussion that we have. So as I told you, yes, uh, again, now, if these are the different industries that we are having, the television, advertisement, digital, social media, sports, entertainment, gaming, print, film entertainment. So it has all these services. So what we have looked at is that yes, how revenue is recognized. Uh, I mean, for a production house, for a television company, maybe for a a theater company, a distribution company, how revenue would be recognized. Similarly, for a production company or a content company, how inventory, how cost is managed, how what would be the impact and what considerations as an auditor you would have to give while auditing fixed assets or the property, plant, equipment, etc., intangible assets, how you deal with maybe a license, a satellite right you have, and how you amortize it or how you account for it is also what we will be discussing moving forward. Now, when we come to the auditing, uh, definitely one very clear a point or concept I want to say is that just because you are doing industry specific audit, the ABC of audit does not change. The basic principles of audit remain the same. Yes, maybe some procedures and some understanding of the client changes, but your traditional audit stages of audit or the audit methodology where you have understanding the client, understanding the environment within which the auditee is operating. Then you have your risk assessment stage, you have your planning, your materiality, sampling, etc. So there is no change in that. But your audit procedures would be more specifically targeted towards these challenges or key, what do you say, key considerations which are there, which are facing this particular industry. Your analytical procedures, discussion with management, communication, documentation, all that would remain more or less same. So therefore, please don't feel that this is, that only thing that is there, but your overall ABC, the overall principles, your methodology of audit does not change. Now, now, as I told you, the main when we do audit, what is our main objective? The main objective of our audit is to opine, and opine on what? Opine on the true and fairness of the financial statement. And when we opine on the true and fairness of the financial statement, we have to ensure that misstatements, or rather material misstatements are, are identified and corrective actions are taken. So material misstatements do not pass through. So therefore, first and foremost thing, we would be, discussing the requirement of this particular standard, that how do you assess, how do you assess what would be the risk, or from where the risk of material misstatements would come. Naturally, I think so. First and foremost thing, a lot we have spoken about industry, but what are the nuances of the industry? How does the industry work? What are the cost structures in this industry? What are the type of contracts that, parties, or the players in this industry are entering into? What are the type of what do you say, the business operations, or the underlying transaction, what is there? So that understanding is important. Similarly, along with understanding the industry also comes understanding the nuances or the regulators which are regulating these particular industry. Like for example, for banks, we have RBI. For insurance companies, we have IRDA. So as far as as far as entertainment sector, or this particular sector, or this industry is concerned, there is a regulator, but that regulator is more on the operational part of it, minimum wages, the safety conditions, etc., on that, and not on the, the financial aspect part of it. So therefore, financial aspect would, definitely the ICI regulations, the accounting standard, the Companies Act, etc., would be applicable. But besides that, what are the regulations governing for that particular sector will have to be looked into. Then to understand where material misstatements could be, observed or could pass through, would be by understanding or the nature of the entity, whether it is a very formal structure, or it's an informal structure, family run concern, etc. What are the internal controls built in the entity itself, whether there are stronger controls, whether there are maker checker system, RCMs are properly laid down, they are tested, they are updated regularly, there are change management wherever there is change, there is, they are there, it's audited, documented, etc. So this would be the important thing. Next is the geography in which the entity is operating. There are different dynamics in south, different dynamics in north, because that also needs to be taken care of. Then besides this also, you would need to understand in India, or even if you go to any developed or developing country, moving outside also, taxation comes very important, and with GST and income tax. So just one example I would like to give you, like recently last year, there was huge UN cry on the gaming industry, because GST implications came on the gross collection rather than only the net income. So even on, so therefore there, that is like, a killer shot on the particular industry. So how that would be regulated, etc., or how an auditor will deal with that. First and foremost thing, how the management is dealing with that. What is the peers in the industry doing? What are industry houses or trade houses doing? Are they making representations to the government? And how it's going to impact the working of the company? What financial impact it's going to have on the financial statements of the company or of the entity? The auditor will have to take care. Then also understanding is on the selection of accounting estimates and the selection of accounting policies that the entity does. So if you take peer comparison, so whether one production house is there and a second production house, how they are accounting for cost, whether on what judgment they are using, what estimates they are using, whether it is comparable, not comparable. And I will get down to little bit specifics in the future slides, where I have discussed, some items of cost, some items of revenue at a micro level or specific levels. So I'm just for this particular moment, I'm just leaving it at that. But that specifics we will get into in the next sometime. And then the financial performances, overview of the financial statements, etc. That is there any stress on the financial statement? Is there any, just from the before getting into analytical procedures, does the financial performance, indicate, in the auditor's judgment or in his, skepticism, does it, ring some bell or, have some red flags that there are continuous losses when, a service industry when losses is not very, unless and until, the fixed cost is, not absorbed, and there's a huge fixed cost which is not being able to, pass on to the contribution. The contribution is unable to take care of the huge fixed cost. So therefore, if the all other players in the industry is doing good and only one particular player is not doing nice, so then how would it impact? That way is another area where the auditor needs to look at it. Then, uh, how do you assess or what, the type of risk assessment procedures that you will do? First and foremost thing, I think so the most important thing which helps an auditor over here are his own experience. One and foremost is where his experience from the same audit of the same entity of the previous periods, or his experience with audit of other peers or other players in the industry, which he could bring on the table and ask relevant questions or do, risk assessment procedures. So that would be the, I believe the foremost and important aspect. Second thing, and the most other important thing, that other than the management, who are the best person who are running the show? So you make inquiries with the management before starting the audit, or before, undertaking these risk procedures. You make inquiries to them, you observe what is happening, you go to their site, or you go to, to their studio, how technologically advanced it is. So when you discuss with them, when you see them and have a, open discussion with the management, you will come to know that yes, when he's talking about that particular studio, or that particular studio is having some problem with the AC, etc., etc., how he's taking care of that, how are they, capitalization is happening, whether that capitalization is for enduring nature or not of enduring nature, whether it's a revenue expenditure, capital expenditure, you will come to know when you visit the site. Then analytical procedures, when you do, it will throw out aberrations, it will throw out, simple, variations which come out. So from there, you can have your risk assessment done also. And then inquiry with internal audit function also, the internal auditors, because they are the ones who, on a concurrent basis, on a continuous basis, do the audit. So they will also come to know. So that will also help you. Then, when we talk about the audit methodology or the audit process, again, this is no rocket science, just as we do for other auditees in any other sector, the same procedures would go first and foremost. Once when the risk assessment procedure is done, then you come to the other procedures, you test the controls, and depending upon the confidence or the judgment in auditor's judgment, how confident he is on the testing of controls, that whether they are operating effectively, they are, preventive controls, detective controls are in place rather than post facto controls. So whether the control system is strong enough, then depending upon that, the auditors will decide on the substantial checking that he wants to do, how deep dive, what would be his sample selection, etc. Then he would test for details based on his substantial procedures. He would check balance confirmation for the transaction audit, for other verification, etc. So that will be taken care of. And then analytical procedures would be, additional to the, the other audit procedures or the testing that he will do. So that's how he's. Then we come about substantive procedures about, revenue. Now here, what we had tried to, or what we have done is, first and foremost thing, you will have to understand that what are the, okay, so here we are just, I'm just starting off with the revenue slide, but as I told you, what we have looked at is, you need to understand the business model or the operations of the auditee that you are doing. So either it would be a simple vanilla production house. That means it does not hold the intellectual property. He just gets on a subcontract basis, some technical creative work is done by maybe the broadcaster. That's how typically it works. The broadcaster gives uh, uh, the what do you say, the story, or the creative content, which is called, it gives it to the production house. Sometimes the production house also sits with the creative team and says that हमें ये करना चाहिए, shooting के लिए ये जहाँ जाना चाहिए, so that inputs also it come. Or otherwise, in a simple vanilla production house, they are like contractors. They will just work on the storyline, they will do the shooting, they will coordinate with the artists, with the actors. They will have the background score. They will do the editing, and ultimately book studios, hire equipment, and shoot the actual content, edit it, and give it in a finished state. So these are simple production houses. Now you also have little bit other companies which are besides simple production houses. They also okay, so that would be production house. Either you have production house for a TV content, either you have production house for a OTT content, or you have a production house for a movie content. So these are the three type of production houses. And also these production houses also do live events. Like just now, I think so we had that which award, that big awards that come, that IFI awards or whatever it's called, Filmfare Awards, etc. So those type of live events coordination, live events management. So these production houses also do that type of work. Then you have the actual broadcasters. So those broadcasters would be like, like a Z, or it would be like a Sony or Viacom, Colors, etc. Those are broadcasters. And the earlier example that I gave was a Balaji Telefilm. Balaji Telefilm is into production house, and it has two types. So two types of production. One, the intellectual property right remains with them. In second thing, the intellectual property rights remains with the broadcaster, and they only do the production and give it to them. So how each and every different entity recognizes revenue or accounts for the content cost, either as a PPE or as an inventory, etc., that are the considerations that will be taken. Then, as I told you, those production houses, then there are these broadcasters, and finally there are these distributors which do not have any complicated issues, but distributors are there. And finally you have this movie exhibitors, like the theaters, PVR, Inox, those type of ones. Then revenue, again, when will you recognize the revenue? Most important thing it becomes is for an auditor that, okay, the example over here, revenue of for a production house that I'm giving you is that how technically it happens is that definitely it's not, production is not completed today and it is broadcasted tomorrow. There is a time gap because the telecaster also will require, say for example, if you are shooting a serial of say 32 episodes, then what you will do is the shooting will start right from the beginning. And once I think so, maybe as per the terms of the contract, 6 or 8 episodes, the inventory of 6 or 8 episodes are there, then the first show will go on live. So as a production house, when will you record that revenue? Because you have delivered, you have performed your obligation, you have completed the contract with the broadcaster that you have completed it much in advance. But maybe before March, you have shot 8 out of the 32 episodes, but the broadcasting will happen in April. So will you defer your income or you will take it as income? That is where it will become important, and that will totally rely on what agreement term says when you are transferring risk and reward, when you are performing your obligation, or where you are, able to demonstrate these things will be important. Then also, as I told you, agreements will be a very important thing, because what is the substance in the agreement? What is the business rationale or entering into that contract will have to be seen. Then definitely, again, what you will do is you check your main object clause in in your articles, and you will see whether the actual business that you are doing is allowed by your articles or no. Then cut-off procedures, what you will do at the year end. Typically, this, one example that immediately comes to my mind right now and I can share with you is, when a production house is there, a production house will actually hire a studio or hire an equipment to the example that I gave you for all 32 episodes. And he has paid rent in advance for these 32 episodes. But he has only delivered 8 episodes till the year end. Then what happens to that cost? How it is cut off? What part of cost it will have? At the year end, also it will have some amount of work done. It will be like an unfinished inventory. It will be there. It will have some, say for example, the shooting has taken place, the song recording has taken place, the background, but the final editing is remaining. Or maybe, some other, cuts, or, that particular, finishing is remaining. So therefore, how will you account at the end of each reporting date is important. Then, as I told you, if you, and again, you have your other substantial procedures as far as your GST income tax is concerned, because typically what happens over here is the timing of recognition of revenue for a production house will be different, and the timing and recognition of the cost at the broadcasters will be different. So broadcasters might have given some advance because these are huge costs, for shooting and all that. Each episode, depending upon the complexity, depending upon the shoot, depending upon the artist, depending upon where it is shot and how big budget that particular project has. It depends. Each episode could go into crores of rupees. And so therefore, when advance is given, how it is accounted, how GST is accounted, etc., will all, be also coming into mind. Then again, if okay, there is not much of export, but yes, if there is an export, are you an intermediary? What is the GST impact on that export will be taken care of. Then again, if you have an FDI in that particular company in which you are doing an audit, and there is a foreign holding, and there are transaction with international transaction with associates, then are they done at arm's length, transfer pricing, compliance, how you have verified. So here somebody tells me that how, arm's length verification is actually not a duty, but then if you are doing, if a company, if an entity is a company, then definitely you will see the compliance of section 188, whether in transaction with related parties, reporting in Caro also you will see. So therefore, whether the transactions with related parties are at arm's length or no, and ultimately then the transfer pricing adjustments that are there. Then when we come again, as I told you, key considerations or substantive procedures that an auditor will have to keep in mind as far as revenue is concerned is first and foremost thing, whether the, what is the legal documentation which is available with the company? What is the commercial understanding? First and foremost thing, they'll have to understand that. And then what are the terms of the contract and what obligations, or when the risk and reward, or when the entity is fulfilling its particular obligation that was there. And based on that, it's the assertion on occurrence, completeness and accuracy will have to be checked accordingly. So therefore, when so you will have to get into your routine audit procedures as far as vouching of transaction is concerned, and then by going through the contract, whether the measurement of revenue has happened at the proper case or no, or otherwise sometimes in some case the terms of the contract are there that you have X amount of cost and your revenue is cost plus 10% model. So the production house will have a 10% margin. So that is how he will have to, approve revenue. Then you have your completeness and cutoff procedures, as I was mentioning, that checking will have to be done. Then from a plant property equipment side also, besides the physical verification and fixed asset entries in the fixed asset register, etc., you also will have additional, important audit consideration that you will keep in mind is on the, the valuation, how it happens, then the impairment testing, how we do, if there are intangibles, like for example, now, if a company has, paid a substantial amount to have either a satellite right, say for example now, I believe one of the Indian companies have got a right of BCCI or broadcasting all the matches in India. So that's for a particular period of time. So that's an, and they have paid upfront fees for that particular acquiring that right. Similarly, now we have for IPL, etc. So that satellite rights are there. Similarly, television rights are there. OTT, digital media rights are there. So how do you apportion that, based on, your period, based on your, timing, based on the number of matches, etc. So what estimates the management has made, that will have to be checked and that will have to be verified by the auditor. Then how a lot of softwares also are used for editing, for for companies which use VFX, for companies which get into translation, or it's called captioning that comes below the movie. So a movie is in a foreign language, or the we see all these in OTTs, Netflix, etc. We are seeing a lot of serials, a lot of episodes, or shows which are in foreign but it is either dubbed in English or with have subtitling. So that subtitling also, so though you require high-fi equipment, you require very sophisticated softwares, etc. So how you apportion them? So that will be a challenge. That will be a key audit consideration that you will have to keep in mind. Then again, sometimes what happens is that after capitalization, maybe imagine, I'm not saying that this is the correct accounting treatment, but just for an example I'm giving you, assuming that a movie is capitalized and then it just does not run. Maybe in the first week or second week, it's, nobody is going, there's no box office collections are very low. Then how do you impair it? Because your management estimate was that it will run for 6 weeks, or, then how will you account for it is again an issue. So that will be, I think so, some issue that we have, identified as far as PPE and intangibles are concerned. Now, employee benefits, again, no specific distinctive different audit procedures that you have to, there, audit procedures more or less would remain same, but you will have to have specific, attention you will have to keep in mind on certain issues. Now, for example, now ESOPs is there. So if there are ESOPs that are given, then how you will account for them. So that guidance is there in share-based payments, maybe not in accounting standards, but now more or less in line with, so guidance can be taken from share-based payments if your accounting standard does not give you certain amount of guidance. Also, there are typical issues where, you have been given ESOPs in the parent company, which is abroad, and not the Indian subsidiary. But yet the Indian, either two ways, Indian subsidiary is, the cost the holding company is passing on to the Indian subsidiary, and the Indian subsidiary is reimbursing that cost, then what would be the accounting treatment? Or secondly, even though if it is not reimbursing, but it is a cost actually shares in the holding company you are getting, but the employee is working, is a key management personnel in the Indian subsidiary, then how will you account for it, even if there is no actual cost reimbursement? So that you'll have to take care. Also, more importantly, sometimes a lot of auditors miss out on the variable pay which comes, because variable pay probably is determined at the end of the year after certain financial parameters are met, after the, or sometimes variable pay is also determined on the overall profitability of the entity. But at least, if a provision is not made and the auditor does not insist on a provision for variable pay or incentive, etc., it would just miss out, and then it would go in the next financial year on cash basis, which is not a correct accounting treatment. And auditor, there is a possibility that auditor will miss out on that. Other long-term benefits, so if it is customary that on completion of 10 years, 15 years milestone, some additional benefits are given to long-serving employees, then how do you account for it? That also is also there, you need to have an actuarial valuation for those customary other long-term benefits other than retirement, etc. That will have to be taken. Also, very peculiar to this industry is a lot of people, like spot boys, or a lot of people who are support artists, makeup artists, etc., who work on contract basis and are not on the payroll of the company. but the respective trade unions or trade associations of those particular artisans or those particular artists, emphasize that this particular minimum wage payment has to be made, this particular, employee benefit, etc. So now, though the Social Security Code has not come into being, but therefore this would be considered as gig workers, and would they be entitled to retirement benefits, etc. These are all the challenges as far as employee costs, which are there. Yes, there could be some other challenges also on the TDS deduction, if ESOPs are there, etc., etc. But I'm just mentioning a few. Then also when you send for actual valuation, the data that you will do is the whether the number of and the assumptions that you will be testing, the number of employees, etc., which the data has gone through. These procedures or these checks you will do, and this is nothing additional or specific to this industry. This is general across any audit that you would do. Again, rent would be a typical, the same type of procedures that you will be doing for estimating the rent. But as I told you, sometimes what happens is that sometimes these sets or studios are taken for a longer duration of time, and sometimes these costs needs to be amortized because the shooting would take maybe 6 months for shooting. Say for example, this a very famous shoot that Big Boss comes, so therefore they would have taken that bungalow or they would have taken that studio on hire. So that shooting takes place over a period of 6 months or so, and then it is telecasted. So then either there is a break in the revenue, a break in the reporting period, and 31st March comes in between. How you will take it? If the show is full shot within one financial year, that's fine. Or otherwise, if there is a break of financial year, then how you will, account for it, etc. You will have to keep in mind. So, and what happens typically is that the rent is paid in advance. For say the earlier example that I was given to you is that the estimated time is maybe say 4 weeks to no sorry longer 8 weeks to shoot that 32 episodes, but then advance is given and it's not refundable, so you have to keep that studio in with you, but revenue you will recognize. So how will you have a matching concept? Because revenue will be as and when you fulfill your, when the risk and reward is transferred, or as and when you will fulfill your commitment and the tapes are handed over. So then how will you account for it? So that's what an auditor will have to keep in mind. Then, yes, this particular slide, though it is a totally accounting slide, but this has importance as far as, as I was telling you, on the verification of the auditor, that when he determines revenue, what steps he he has to keep in mind. So therefore, yes, as per the, the standard, the IGAP which is concerned, yes, it is, quite simple and it is, very straightforward. But there is a comprehensive Ind AS on revenue from customers. So therefore, this talks about this 5-step model, first and foremost thing. But I'm not going to, as I told you, this is not an accounting, seminar, webinar is on the auditing. So I will directly come to the, audit issues that are there. So therefore, one of the issues over there is that after you identify the contract or you identify the customer, what is the, what the business consideration is, then sometimes what happens is that sometimes there is a multiple performance obligation is there. Say for example, when you go to a movie and you buy a movie ticket and you get a free Coke and popcorn. So it's a movie ticket is X amount and you get free popcorn. So therefore, if there are so you are also giving him a service. The theater is also giving him a service of a movie this thing content display or entering showing him the movie, plus he's selling him the goods of a popcorn and selling him a drink also. So in that cases, how do you account for it? So management will take, I mean, based on how it is, the accounting treatment, but as an auditor also, you need to be aware that what is the correct accounting treatment and how you will treat for it. Similarly, you also have, sometimes, there is cable TV and there is cable TV and installation that takes place. There is a line which are there, And also these lines or the infrastructure that cable TV lies, you can use other, it is used for internet service also. So therefore, there could be multiple performance obligations. So how you will account for it? That also is there. Then most important as far as revenue concerned is that whether the revenue has to be taken at the point of time or over the period of time. And at the point of time would be that you will have to look at the commercial substance of the contract and how the entity which you are auditing, if he has performed his obligation or he is able to demonstrate that if the risk and reward and control is transferred at that particular point of time, then yes, then that will be accounted that way. But there are certain conditions that when the revenue cannot be recognized at that point of time, when there are continuous service, over a longer period of time. So therefore, whenever, the entity, so this is the criteria which, if according to the standard, if any of the entity fulfills one of these criteria, then it is said to be that the revenue has to be recognized over a period of time. Like how in your accounting standard, we earlier in IGAP, old IGAP, we had, accounting for contracts. So this accounting becomes on that basis, that how do you estimate what is going to be your, what was your budgeted revenue, what was your budgeted cost, so therefore what is your budgeted profit. And at a point of time, if you have not completed your full obligation but you are in the process of completing your obligation, what percentage of your budgeted cost you have complied. So therefore, that much amount of proportionate revenue you will have to book, even though you have not completed, it is work in progress, etc. So that is the guideline that is there. And, the auditor will have to be aware. So not only with the requirement of the standard, but it will also will have to be aware of, what the commercial substance, what the contract says, and what it has to, do the audit, and whether the auditee has, accounted for the revenue correctly or not. So then now, what we have also given is that these are, certain synopses of accounting policies of listed companies that we have shortlisted. So this is all available from public information. Just give me a break for 1 minute, please. Yeah, thank you. So these are all the, extracts of significant accounting policies which are available from listed companies. So it is nothing, it's all publicly available information. So here, let us, just examine how the revenue is recognized for this particular synopsis is accounting policies that are adopted by PVR and NOx. So on sale of tickets, so on, when will he recognize on the sale of tickets? As and when the film is exhibited. So therefore, this is not very complex. This is very straightforward. But as an auditor, you will only have to keep in mind that suppose the sale of ticket happens on 30th of 29th or 30th of March, and the movie is to be shown on 2nd of April. So will he defer the revenue or he will not defer the revenue? So therefore, what is the stand that auditor will have to take? He'll have to be seen that what is the obligation? What is the obligation of the theater is to show or exhibit the film. So when is the exhibit? So first and foremost thing, is it, when the risk and reward or where that performance obligation will be satisfied. So he will be satisfied when he has distributed or he has, performed his obligation. At that time, the revenue will have to be recognized. Then similarly, again, for sale of food and beverages, I gave you earlier example of for food and beverages is that, that when the control is transferred. So therefore, that will be coinciding with the delivery. So that will be at that point of time. Then more importantly, I think so this is an important point where as an auditor, we have to be very careful if we are doing audit. When, now there are these gift coupons or gift vouchers that we usually, sometimes we give a PVR voucher for 2,000 rupees or 3,000 rupees we gift it. And therefore, how do you account for that breakage revenue? So therefore, what happens is that somebody has bought that voucher and that money has come to the exhibitor, but that gift voucher is not yet used and it will be used in the future period of time. Then how do you account for it? It becomes a little bit of complex because yes, had it been in the same financial year, had it been in the same financial year, if somebody buys a gift voucher from a company, definitely it's not a revenue. So it will be shown as a liability that yes, this is an obligation that has to be fulfilled when the gift vouchers will come for redeeming. So that is one particular thing. Then the redemption takes place. A full voucher is redeemed before 31st March. The theater company has fulfilled its obligation. He's shown the movie, he has encashed, the person who has got the gift voucher has encashed it, and that revenue is booked when he has come to see the movie, that's delivered. But what happens is that these unused gift vouchers are there and the year end closes. So, therefore, then how has the management accounted for this breakage revenue? Is it so that is where the management estimate or judgment, rather, management's estimate will come. And based on the experience of the auditor in his judgment, whether the management estimate is correct or wrong, he will have to opine. So therefore, many a times what happens in this is, again, I'm telling you that this is not accounting, so I don't want to give accounting guidance. But yes, in this, the revenue will have to be recognized based on what the past experience shows. Because many a times we also see that many of these gift vouchers come, but some of them are not encashed only. It is given a gift and either they expire or, because they have a validity period, they have a expiry, finite expiry after 3 months, 6 months, etc. So therefore, this, it happens in not only this, but other businesses also gift card. So then how you account for it? So here the management will have to go on the past experience, and we have instances where the management has been so meticulous in calculating even the time buckets in which, so maybe they, the and past experience shows that these gift vouchers within maximum redemption happens within the first 30 days. Then maybe 80% or 70% of the redemption happens between the first 30 days. Then maybe less than that also, and then the balance, and then as and when the period elongates, the redemption rate comes down. And finally, there is an historical trend of historical data which will show you that that particular, at least say 20% or 30%, or maybe, depending upon the case to case basis, those points never come for, sorry, not points, the gift vouchers never come for redemption. So then how will you recognize? Will you do an actual valuation? How will you do an assumption, management? So that would become a challenge. Then the next one is on advertisement fee, which is pretty straightforward. As and when you are displaying the advertisement, it will be display as and when the advertisement is displayed, and as per the terms of the contract, they will earn and recognize revenue. And it will be simple for an auditor to, even if he wants to physically verify, he can take photographs and where that particular advertisement was done, and that can be displayed, because there will be an internal system which will be recording that that advertisement was to be displayed for maybe 6 days, or maybe 4 weeks, and etc. It was displayed. Then on the convenience fee, how it is accounting for it. So convenience fees actually would mean if you are booking a ticket on the app, then how the convenience fee. So therefore, maybe if you are booking a PVR Inox ticket on a Book My Show, then convenience fee will definitely go to Book My Show and will not come to PVR. But PVR also has an app, and if you are booking directly on PVR's app, then how will you have the convenience fee? So that will be actually on accrual basis. As and when the tickets are booked, the convenience fee is earned, received, and accounted for. Then rental and food court income. So that is again based on the space and the terms of the contract or the lease arrangement. You will have to account for it. Then print fee income also is on accrual basis. So there is no much this thing in that. So virtual print fee, the virtual advertisement that would come. Then that was as far as the revenue was concerned. Now, how is the auditing? I mean, what consideration you will do when there are intangible assets? So yes, there are these some film rights which are the not telecaster, the film theater company would have paid certain amount upfront to the production or the distributors of that particular film to exhibit that movie in their theater. So therefore, this would be accounted for as an intangible asset, and it will have to be written off, based on, first initially, yes, it has to be capitalized, and then it has to be written off based on the management's estimate that on the on say for example, now it has paid, say 300 crores to show a particular movie for a period. Now it estimates that in the first week itself, the company or the distribution will make, 200 crores, and then 100 crores, and then 50 crores, and then 25 crores. So therefore, so based on consumption pattern, this amortization of this intangible asset will happen. So therefore, whether the judgment or the estimates of the management is correct or wrong, an auditor will have to check. And maybe it might have to also rely, if it is used on past data experience, and if the auditor is convinced, then he'll have to use the past data and the trend that is there. Then this particular is a very peculiar thing, that this only happened because of the merger of Inox into PVR. So therefore, these particular things were there, that they paid amount, some amount was paid at the purchase price allocation over and above the fair value. So that was the brand that they acquired. So that brand they were amortizing over a period of 20 years. And yes, definitely they will do an impairment testing at the end of each year or reporting period. So that testing would have to be done. And that lease right is fine. It's over the remaining lease period. So that also is pretty much straightforward. Then we come across revenue recognition of Balaji Television. So these examples I have been keeping on giving you, that how the revenue has to be recognized. So as I told you, first and foremost thing, television program. So you understand that first, Balaji is not a broadcaster, so it's not a TV channel. It makes either movies for itself, where it holds the intellectual property rights and it can exploit that. That is one segment. Second segment is that it is making TV content, and or maybe it is making content or is a production house for TV content and OTT content. So then how will he recognize revenue? So here he will have to recognize over a period of time, as I told you, because it's not at the time of, say, risk and reward that gets transferred or the control that gets transferred. Because as I told you, sometimes, these episodes go into long period of time. And imagine a show, we had that show, one Tarak Mehta show, which went on for years. So that production keeps on happening continuously. So therefore, then how will you account that at the at the time you have delivered your last episode? 32 episodes. I gave an example, but maybe you have long running shows also. So therefore, it's not there that from one to last you deliver your 10 episodes or 32 episodes as per contract, and you will pay. No, you will recognize revenue. As and when you keep on delivering, you'll have to recognize revenue over a period of time. And how will you recognize that revenue? As I told you, first and foremost thing, one, maybe if the management has actually, recognized revenue based on percentage completion in the old accounting parlance, if we say, then it will do a comparison of the actual cost that it has incurred so far and the budgeted cost that it has. So maybe if the budgeted cost was 100 crores for so many episodes and it has incurred 7 episodes, it has incurred 70 crores. So therefore, 70% work he has done. So therefore, he will recognize 70% of the revenue as on the reporting date. So that has to be kept in mind, and whether that is correct or wrong will depend upon the audit procedure that an auditor verifies, that as per the terms of contract, whether it is milestone payments are there, and milestone sometimes typically this I'm aware, because what happens is that, as I told you, advance is received from a client. So therefore, if you try to verify or do an alternative procedure or verifying revenue of the production house along with, say, for example, a production house is making for Star TV or some commercial or some television content. Star TV will keep on giving advance, and in their 26 AS, if I want to verify income as per 26 AS, it will never match because on advance payment, Star will be deducting the TDS. So therefore, and GST again, GST would be on, suppose if I want to, cross check with my GSTR return also, that what will be the revenue. So that will match with what invoices I have raised. But for the earlier example that I was giving you of the TDS amount, that will, if I want to carry out an alternative procedure of 26 AS reconciliation, that will not be simple. It will be, a very complicated issue. So that particular, thing you will have to keep in mind as an auditor, that when you do this, you'll have to keep detailed working and verify on various costs, that what are the costs, what are the budget, and then it may also so happen, and this typically happens. Life is never so simple. After 5 episodes or 6 episodes, it goes very good. The response from the viewers is very good. More advertisement hits, more advertisement revenue they are getting. The viewership is increasing. Then what happens is that they say, okay, let's get a celebrity. So the budget changes, the cost changes. So therefore, all various combinations come. So therefore, how do you account and how an auditor is satisfied with all these changes in assumptions, changes in estimates, etc. It'll be a real challenge. So that is where I think so as a production house, you'll have to, as an auditor, key consideration that you have to keep in mind. Then again, as I told you, Balaji makes movies on its own also, and it holds the intellectual property rights, it holds the licenses. When it sells the license to a movie for a particular person to consume or a particular, right to use, then when he will recognize. So suppose, for example, Balaji has made a movie and says, okay, that you can, show this particular movie on your television channel for 6 months. So, I mean, it's up to you whether you want to show it, once in, 6 times you can show over a period of 6 months. Then it's up to you whether you want to show it one episode per month, or you want to show 4 episodes in the first month and then follow it up with one re-telecast later on. So here, how do you account for here? Balaji says that it recognizes the point of time that once I've given you that licensing rights for 6 months, then I have fulfilled my obligation. Now it is up to you. I don't have control on when you are going to telecast that. So therefore, I will recognize when I get that money or when I enter into a contract of giving this licensing. Then service income for curation of digital content. So again, this will be at point of time because it will not fulfill the criteria that has been earlier I had discussed. Because if I am making a content, then I have to complete the content and I have to give it at one point of time. Because what will happen with the incomplete contract is that person will not be having an alternative use for that incomplete contract. It will not. So therefore, once I complete my obligation, I will recognize revenue. And revenue from events is pretty much, it is over a period of time, it is pretty much straightforward. Then again, here is on the amortization of cost of films, as I told you. Amortization is the ratio of current revenue to expected total revenue. Say, for example, now if there is a cost which has been incurred and that is lying in my inventory. So therefore, I have made a movie and I have kept it, that full cost of the movie I have taken as a cost center and say an XYZ movie this company has made. And now I have that full cost which is there. Now for me, I mean, it's for Balaji, they are treating that as an inventory. So therefore, how will the consumption take place? So therefore, say for example, they spent 100 crores to make a movie and it is sitting in the inventory. Now it is available for selling out the licenses, or it is available for people to use it. So in the earlier slide, we saw how revenue will be recognized. And here we will see that now, of course, the movie rights will have different. So maybe major part of it, movie rights. So today, the life of the movie is what we have seen, that the life of the movie first, initially it is in theaters. of the distributors, and then after that it comes on television or OTT, etc. And then very few, also we have a few channels which show only old movies. So therefore, there is some life even after 5 years, 10 years of a movie. Also, there is this life. So therefore, it will for this particular Balaji Television who has made the movie, it will be an inventory. The management. So it's up to the management to decide the amortization policy or how it will write off this consumption. So if it feels that 80% of my cost I have to recover in the first 3 months itself by distribution and by theater release, etc., then worldwide television release, etc., then they will amortize that accordingly. As an auditor, it will be a challenge for us to see, because management, either it depends, they either want to show higher profit, so therefore they will have a more less aggressive investment amortization policy, or it depends if they want to save on tax, vice versa, etc. So therefore, auditor has to be independent and verify and use his professional judgment that how it, how it has, the company has amortized this particular cost of inventory or cost of movie, and how, past data, what it shows, etc. So that will be a challenge. Then after that, so if there is particular audit documentation and contract, it won't have a contract, but the audit documentation of how it keeps the management representation, what the auditor keeps, would be key to verify this particular area. Then this again is from Viacom 18 Media. This is nothing different. I'll just tell you if something different is there. Sale of airtime, it is based on telecast of advertisement. So yes, if there is an advertisement, then of course it would be on the date of telecast itself. So it would be that way. Then distribution of satellite channel. So right to receive the subscription as per the terms of the agreement. So suppose if you have a satellite channel, then you will receive based on subscription. So this will be over a period of time, as and when every month you are performing your obligation. That way you will recognize revenue. Then licensing and merchandises, it is performance obligation. As and when you are performing, it will recognize revenue. Then licensing of content, as per the licensing agreement, when the right to use of the content is there. And theater distribution movies, again, as per the licensing agreement, as and when the films are screened, the revenue will be recognized. So I think so this is a lot that we have discussed. Again, on the Viacom 18 inventory model, expense of based on expected pattern of realization of economic benefit. So this is again what I told you that we showed in Balaji, that how the content etc. How it is amortized if it is shown as inventory. Then acquired rights of show and music. Again, this is over the licensing period. So the second one is pretty much straightforward, that if you have acquired a right, or if you have acquired some music rights to be aired, then if you have a licensing period, say you use this for 3 months, 6 months, etc., then you amortize over that period, or maybe 2 years, 3 years, etc. And then plant, property, equipment, that suppose if there are certain expenses or certain projects that fulfill the criteria of future economic benefit, then that will be accounted as a PPE. And if that particular project is not completed or not ready for its intended use, then it will be shown as capital work in progress and then transferred to, or then capitalized at a later stage. Then inventory. Then this is again TV18. So TV18 again, just let me see if anything is different, or otherwise if something different is there, we can discuss. Cost of shows and events and films, expense of based on expected pattern of realization of economic benefits. So again, this is what we see. This is uniformity, harmony between most of the players in this particular industry, that how they are amortizing inventory. Acquired rights of shows and music, again, over the licensing period. programs purchased and the cost of program in-house expense of based on number of episodes telecasted during the period. So therefore, here TV18 is it's a little bit of a different company because it has its own in-house production also, and it has a own in-house TV channel also. So so therefore, it is something more like a NDTV or something like that. So therefore, it is expensive over the full program. Either it is purchased or cost incurred on in-house production is amortized over the number of episodes telecasted during that period. So it goes on that. Then cost of news. So therefore, this is again different. So now, current affairs programs or one-time events or, cost of news, etc. So for example, TV18 also has a subsidiary and CNBC TV18. So those are more current affairs programs. Those are more financial market related programs, because then they don't have you will never see, say for example, there are some programs, Opening Bell, or they have something like an afternoon, what is happening. So therefore, these are very daily and very, current programs. So if they are on current program, they don't have future economic benefits. So therefore, they are any expenditure on that is fully expensed off in the year in which they incur only. So that is how it is. Then capitalization policy is pretty much similar to what we had discussed earlier. Then we have again audit considerations, which we can look at other than what we had discussed. First and foremost thing is on barter. We have observed that many in this industry also have a transaction which is barter. You have a company which says that, okay, I'm taking some content from you, or you render some services to me, and I will not give you money in exchange, but I will advertise your product free of cost. Then how will you account for it? So current accounting standard does not give any guidance, but yes, there is guidance in India's 115, which talks about what is the fair value of the either goods or services which we have received. So based on that, so say for example here, if we have taken a content which in normal consideration, he would have charged say 25 lakh of rupees, or some software or some service or some good, the fair value of which is 25. And I have said that, okay, I'm giving you 3 slots of prime time advertisement for 4 days. Then that would be the revenue for the value is exchange. So again, here the problem is that what would be the GST, because you will recognize revenue, but in per se, it's not actually a revenue. It's only a 115, accounting entry. So whether you will pay GST on that, whether the person, and and of course, fair value of that good also, if you account for it, then there's going to be no exchange of money. So there will be an income and a corresponding expenditure. So will you deduct TDS? Will it be allowed in income tax? So those all issues will come. Then again, as I told you, most important consideration or challenge as far as audit is concerned is on governing on how do you recognize revenue at a point of time or over a period of time? It has to be based on transfer of control of those particular goods and services, and whether the company has been able to satisfy the performance obligation as per the contractual terms. So basically, this an auditor will have to keep in mind this particular concept before accepting the accounting treatment that the auditee has done. Then again, the matching concept becomes important, because if you are doing revenue, recognizing revenue, but say a production house is recognizing a revenue, but against which the cost it has not recognized, then that also is not incorrect. Or maybe as the example that I gave you earlier was that, okay, he has taken a studio or he has taken a services of an editor, etc., and he has paid up, and the terms of the contract says that that particular is for all 32 episodes, but I have recognized revenue only for 8 episodes. Then will I defer the cost of the balance 32 minus 8, 24 episodes? Will I defer it and I will recognize that cost when I recognize revenue? The answer is yes, because you will have to have that matching concept. Or otherwise, then if you are going on your percentage completion, then you recognize revenue for the total cost. But this is one particular aspect and not the total cost. So therefore, you are not, it is one particular aspect. So therefore, these type of costs, to have a matching concept, you will have to defer it where the revenue is recognized. Again, I just touched upon that, how you determine how much percentage that work that you have completed. So one guidance that comes is, and this is the most, what do you say, reliable guidance, that, you take a estimate of your incurred cost upon your budgeted cost. So therefore, that is an indication of the percentage that you have completed, etc. And maybe you recognize your revenue on that particular basis. So that would be a more important reliable. Then again, as I told you, reporting on cutoffs, this also we have discussed at length earlier also, that how cutoffs are taken care, whether there is any expenditure or whether incurred but not accounted for, etc., will have to be budgeted as far as estimation of cost is concerned. If there is a cost escalation, how you will account for it. If there is a cost which is incurred, not yet incurred, but maybe there is a very contingent cost that you are fighting for it, but at least some management estimates you will have to take before the year end. Say, for example, a fire has occurred and you have to pay a certain amount of compensation to the owner of that studio. Now that is in negotiation. But if you have a year end or reporting date, you know that there will going to be some obligation on you or some liability on you to provide. So therefore, whether you have included that in your cost, etc., will have to be taken. Then again, royalty income, because a lot of these film productions or these who have the copyright, intellectual property, even they have this royalty income which keeps on coming. So therefore, definitely, if there is an agreement with the person who is using your intangible asset or your intellectual property, then how you will account for that royalty income, what would be the tax implications, tax, GST, direct, indirect tax will be taken care of. Then again, as far as I told you, recognition, inventory, how, what would be the key consideration when you do, audit for the inventory? What is the recognition, whether it is enduring in nature. So whether the cost that has incurred either on the film production or on the episode that you are doing, whether you have the intellectual property right or you don't have. So all the various combinations which I discussed earlier. So based on that, you will say that either you will take it as inventory or you will take it as PPE, or that is fixed asset, or you will debit to the cost of profit and loss. As I told you, these current affairs directly, they don't have any inventory, etc. The current affairs program, because they don't have economic value, they can't be re-telecasted. So therefore, it has to go as a P&L cost of the period cost itself. Sorry. Then broadcasting right is an element of cost. So therefore, what would be actually your part of your cost? What would be your cost? How will you measure cost? So actually, the cost will be the purchase cost, your conversion, etc. So even if you have outsourced or bought content, or you have in-house not done, but also taken some subcontract work or given, so that part of it also would come. And then consumption, as I told you, based on expected economic benefit, how you will do that. Another important thing is that whenever you have inventory or PPE, you will have to have a challenge to do impairment testing, because management would like to use or not use impairment as per its requirement. But we as an auditor have to see that whatever is the current economic consideration of that particular asset, which is the carrying value. So whether it is cost or NRV, whichever is less, how will you determine NRV? That is cost to complete minus the cost of expenditure. So whether your carrying amount and value in use, so therefore value in use will be lower of what, etc. So that you will have to be, keep in mind, and then do an audit of that. Then again, as I told you, cost of incomplete projects, these are ongoing projects. And as I said, that expenditure will not, has to match with the revenue, or expenditure will be a period expenditure, but the revenue will be amortized. So how will you carry forward the cost of incomplete projects, either by way of PPE or as far as inventory is concerned? How will you have that? Auditor will have to be a challenge, and that they will have to look at it. Then these also most of the points I have discussed. Yeah. So for example, now IPL rights are there. So IPL rights, or maybe there are certain television houses who get either from Bloomberg or etc. some rights licensing fee. So licensing fee, it will be capitalized, and then amortized policy kya hai, over the period of licensing. So that becomes very simple that, okay, you have this licensing fee and then you have a period of 5 years, then you amortize over a period of 5 years. Either you have a telecasting right and satellite right. So either will you do it a simple amortization or over a straight line method, or you will do it over the period of your expected economic life, whether you receive it. Based on that, you will do an amortization. So that will be a challenge. What is the management's, estimate in that policy, accounting policy, and whether you concur with that, by way of past experiences, your contracts, your, how the customer has behaved in the past, etc., will have to be seen. Then capitalization of electronic installations, machinery, studios, equipment. So this is not anything different than any other PPE audit that you would do for any other manufacturing or any other service or IT company, etc. But you will have to be specific in use, because here there are certain very specific equipment, very sophisticated equipment, which an auditor would not be capable of estimating its useful life, and the management may misuse that, because that estimated useful life might not be, as per schedule 2 very strictly, but the schedule 2 allows you to have a different estimated useful life based on your technical assessment and based on a certificate by a technician. So therefore you would have to rely on some other expert in some other field to determine the estimated useful life, etc. What would be the residual value, whether you will have any residual value, etc. So that is being covered. And what would constitute cost, in that asset, whether that particular is a routine cost, a revenue cost, or by incurring that cost you would have some future economic benefit, etc., will have to be considered. Then very specific instances that we have observed, that these are other other than what we had discussed so far, that other areas that you need to keep in mind. Say for example, now this is very common and we've heard that there are bans on some shows, there are bans on some utilities, there are bans on some games. Say for example, now one particular Chinese app and all that were banned. So therefore, if you are, I'm this is just giving a Chinese app as an example, but suppose if there is some adverse regulatory action, what impact that would have on the company is the most important thing that you will have to see. First and foremost thing, you'll have to sit with. First and foremost thing, you'll have to understand the impact. Now, the two examples that I've given here is banning of a product, or banning of an app, or banning of an episode. You can't air it, or you will have a stay on that, or somebody will say that these are disturbing my sentiments, or you have copied my life. There are so many issues that we've had this, or some apps are banned, some gaming apps, etc., or a GST issue that came on these gaming companies. So these are regulatory actions which have an adverse impact on the functioning of the company. So how will you do your assessment? First and foremost thing, you'll have understand the full adverse impact. You yourself will, based on your judgment as an auditor, will do an impact analysis or impact assessment, and then you will discuss with the management that what is the management's view, what does they feel. Is this a company specific issue, like a banning of a app, or banning of an episode, or banning of a product is company specific, but the GST on that full gaming company is in an industry specific. So whether what is going to be that impact, what does the management feel, that the first and foremost thing. Then if you are little bit debate, then you can get into a legal opinion, because yes, on accounting you might not require an opinion, but on the outcome of a probable dispute which would take a longer period of time, you might require a legal opinion, and based on the probability of that liability incurring, or that outflow happening, future outflow happening, you will take a call whether it would be a contingent, whether it would be actual liability, and account accordingly, either disclose it as a contingent or account for an actual liability. Then you yourself, based on all the information you will have, you will do an independent verification. You will speak to industry people, you will see what is happening, what others are doing, so you independently will verify. Then you will discuss with the management. Yes, you will escalate the matter to those charged with governance. You will discuss it with the audit committee, or with the management. Take specific specific representations on that. And based on that, you will insist the management to have a note in the financial statements, depending upon the materiality, depending upon the the graveness of the situation. And then after that, based on all these things, then you will follow the SA 700, whether in your opinion paragraph, whether it would be whether it's an emphasis of matter paragraph or it requires a modified opinion. And most importantly is on the going concern issue, that if this that's the only product of the company and it has been banned by government, what is going to be the going concern? The revenue stream is going to stop, no new addition subscribers, no new revenue stream is going to come, plus the costs are there, borrowings are there, whether the company will be able to survive, meets its liabilities or no, going concern issue. So this will become an important aspect. So this is one challenge that is very specific to this industry. Second thing is also we have observed that many a times these are new age businesses, new age industry. So there's a lot of co-branding and co-branding partnership are there. So for example, you have a Kotak and PVR card. What will you do with that? You have co-brand credit cards. So therefore, the model works on sharing of revenue. Then, if say for example, a bank takes a branded credit card, co-branded credit card of of your Audit, then whether the bank is sharing its revenue with the bank or no, as per the contract, as per the terms of the contract, it becomes important for an auditor to see. So therefore, banks have got either first an entry fee and the renewal fee, and other charges are there. So whether that percentage sharing of revenue is got, how will you verify? Because the data will be available with the bank. You will not have the credit cards issued by banks or your co-branding, but it will be your brand. So how will you verify? That will be a problem. If there are certain discounts and offers, say for example on points or some accumulation, or maybe if you buy 3 movie tickets free if you buy from a particular bank in your show, then how will you account for that discount? Who will be sharing that cost? Whether you will be sharing, or that loss of revenue which has happened, how much percentage you will pass on to the banker and how much you will bear. That would also depend on the terms of the contract and how you verify that huge data, and how the management has that information, that okay, whether this ticket was booked by this card, etc. That you will have to check, and it becomes a complicated exercise, because many a time the revenue happens, but from which particular credit card, that is not there. So what procedures have you carried out? Have they maintained a separate bank account only for that credit card, etc., where all the realization, etc., happens, or whether they have a common payment gateway, etc., that you'll have to see. Then there are certain promotion costs. Then how? Because you see huge advertisement cost which is incurred. That if in co-branding, partnership is there, then there was one time, promotional costs are there. How you share it with the co-branding partner also becomes important. Next important point is on the reward points, on the, how do you recognize, measure and account for this reward points? Because you have this loyalty, customer loyalty point, that if you visit, any of these theaters or any of these particular apps you use, you add your points on that particular app, and then either you can redeem those points or convert it into rupees, etc. So those what are so that so it is a liability, potential liability at the end of every reporting period. You will have to see what are those points, what is the fashion in which past customers have behaved, whether the points are lapsing, whether what is the validity of that period of those points, how is the customer behavior in redeeming those or in converting those into your actual liability, etc. So that will have to be taken, and based on that, these particular assumptions the management have to be made, will have to be given to the actual evaluation, and liability will have to be booked on that, and auditor will have to check those particular aspects of it. Then more important, what we have seen is the treatment of development cost. So what happens many a times is that there are certain amount of games which are developed, and that before the games go live and before they are tested. So therefore, this is the cost that is there at the development stage. Similarly, sometimes episodes are made just for trial. That okay, the storyline is given, and one or two pilot episodes are made for the production house, and then given it to the the telecaster that this is what we have done. So maybe it is approved, or it is not approved, or it is approved with modification. Additional cost will have to be done. So before the stage takes up, before you start recognizing revenue, these are all that cost of development. So how will you whether how do you treat it, whether you will take it as a whether you have any economic benefit that is going to come, or directly it is a sunk cost. If it is a future economic benefit, how are you amortizing, how are you what is the method, what is the estimated useful life, or it is just a very uncertain. So therefore, are you following the policy directly of debiting your P&L, etc.? As an auditor, this will be important also. And lastly, there is a problem on external confirmations, as I told you, not only in this particular industry, but the response from external confirmations asked by the auditor and received by the auditor is very, very poor. And therefore, what alternative procedures you have done? Okay, you might have checked with 26AS and etc. But many a times it becomes difficult because you have retail customers. So retail customers definitely they will not be in a position to confirm your balances. But if you have I definitely for sure know this particular practical experience, because if they are dealing with one particular production or telecaster or broadcaster, it maintains separate accounts for separate advance, then some amount they withhold for successful completion of that, and then that money is released only after all you perform, all your episodes are delivered, etc. So how you account for that balance confirmation? Because you might be maintaining only one balance, but the broadcaster might one account, but broadcaster might be having multiple accounts as far as these different transactions are concerned. You are working on multiple episodes or multiple projects with the same production house. How will they account for it? You are maintaining it definitely. They are maintaining one consolidated. So this will be a problem. So how what alternative procedures you follow, etc., would be an issue. And with this, I think so. I come to an end of my presentation, which I had for you all today. And I hope this key audit considerations on the entertainment industry was pretty entertaining for you all. Thank you.
Thank you so much, Manish. That was indeed entertaining. I would say more than entertaining. That was more like a very, very technical presentation, which you have actually shared with everyone. I think it's quite practical. We can see definitely it is based out of your experience with respect to the audits which have been conducted.
Thank you.
So we have some questions with us. Are you good to take some questions?
Yeah, sure. We have some time.
All right. I'll
Just
just
ensure
share
that the questions are not out of syllabus.
I don't think so. Look, some looks like quite futuristic, and maybe people want more clarity, but some to me looks like they are more with respect to what you have already spoken about. So first question is with respect to if a show expenses are borne in current financial year and broadcast will be next year, how the revenue and expenses will be recognized in the current year?
So as I told you, that show expenses, if they are booked in this year, it depends on whether you are the production house or you are the telecaster. So for example, the example that I gave you of CNBC is there. So suppose if CNBC is in-house creating this content, in-house doing this production and incurring the cost, but the broadcasting is going to happen in the next financial year. Definitely, if you have not fulfilled your obligation, then definitely it will not happen. It will come as an inventory. You will have to carry forward that particular cost, because your revenue will start coming from the next quarter it has happened. But if it is you are a production house and you have fulfilled your obligation, and the responsibility of telecasting is not yours, but it is of the television company, then you have fulfilled your obligation. If you have cost you have incurred, then you will book that percentage or that proportionate of that revenue compared to that. You will have to book it and recognize revenue to that.
All right. Thank you for that. The next question is that do we have human capital accounting concept in the film industry? Since it primarily revolves around the actors and directors and their continuity and longevity in terms of capitalizing the movie that is getting produced.
It's a very good question, but in my practical so far, I have not come across.
All right. Then, if a content is made for future use, do we need to consider the content value as inventory or IPR or anything else?
Sorry, what is?
If the content is made for future use, do we need to consider the content value as an inventory or as an IPR?
It again depending upon what your model is. Mostly it will be like if you are going to exploit your IPR by selling the licenses, then it will be an inventory. Or if you are going to have a self consumption, then you will have it as a PPE. So when we were going through these listed companies, also some of them also, they do this news archiving, and that they capitalize the cost of news archiving because they feel that the economic benefit of from news archiving would would be more than a year's time, and therefore they capitalize it, and they have an amortization policy based on the management judgment that when over what period of time they are going to have that economic benefit. So therefore they are amortizing over that period. So depending upon your business model.
All right. Then we have a question with respect to if any show is resulting into onerous, what audit procedure one can plan on year end?
So if it is coming, it's becoming an onerous. So therefore, what I understand from this question, onerous, is that there is definitely going to be a loss on that, and there's a cost
Yes,
overrun. So
right.
that cost overrun will have to be accounted for in fully, even though there are some costs, say for example, which I told you that some costs, say for example, a fire cost or some major catastrophe has happened, some compensation has to be paid, some accident
Right.
in the set, etc. That will have to be accounting. And if it's an onerous, then definitely yes, it will not be revenue, but that full cost will have to be accounted in that particular reporting period.
Okay, pretty much like that, how we account for the onerous contracts.
Yeah.
Yeah, okay. The next and the last question which I have is what considerations are given to the impact of global economic trends and geopolitical factors on the film industry?
This is more of an industry problem. I mean, industry and not from an auditor's problem. But say, for example, as I just gave you some few examples, this is more of theory. But say, I mean, if you have made a movie which is hurting somebody's religious, something, then what impact it would have, and maybe if it is just not material and it is one of the many shows that they are producing or one of the many, films that they are producing, whether so definitely an accountant and an auditor will not look into the loss of reputation or maybe getting some arrested, or it will just look at the either any financial penalties coming, etc., any financial impact as such. Non-financial impact, an auditor is not required to check.
All right. Great. I think we are well within time and you have answered all the questions which I got. So I think thank you so much, Manish, for your time and the way that you have taken us through in a very, very detailed manner with respect to also the challenges as well as the possible solutions with respect to the problems which the industry is facing, and also as an auditor, what one needs to take care of when you are doing the audit of so-called entertainment industry. As you rightly said, that the word is very loosely used sometimes. It is a very specific, right? Be it digital platforms or be it the content creator these days. Of course, I know a couple of content creators who are actually they're in a dilemma because this is an industry wherein within a very quick span of time, a lot of people, if you talk about even the influencers, right, who are into the YouTubers and others, they have grown like anything. Within a year span, their followers or their subscribers have gone up. So they really feel the challenge. And I think with what we have spoken about, there is a lot for them also to take home and understand. So I would now invite CA Gaurav Maini, my fellow moderator, to take it up.
Gaurav, you're right. I think so what important development that is going to happen is how you have a regulator for different industries. A regulator
Definitely.
shortly will come, I think so. And I think so that will be a very much, it will be a boost to this particular industry. And once you
I'm
have
sure.
proper regulations and proper accountability and more data, stronger data protection and data privacy rights, I think so this industry is just about to actually, just, take off from here.
Definitely, Manish, like the way the censor board we have been talking about, the OTTs are not probably they are privileged enough, or they were privileged enough that they were not under the radar of the scanner or the scanner of the censor. So, but yes, now you see that a lot of regulations slowly and gradually have been coming on them as well. Not formally, but in a way that morally also they are becoming responsible, because otherwise people start boycotting. This trend of hashtag boycott is becoming famous these days. So, as auditors, we are lucky enough that we are out of it. Now I give it to CA Gaurav Mani to take it up. Over to you, Gaurav.
So, Manishi, I have a set of few more questions for you. I hope we have some time. So, the first question is, please explain the program for audit of a news channel, unrecorded advertisement during displaying of news.
Audit of just a little specific audit of
Unrecorded advertisements that are displayed during the news telecast.
unrecorded. I don't understand that question. Unrecorded
Maybe
advertisement.
they want to know about the ads that are running, clips or the ads that are running during the live telecast of news broadcast.
So those are actually based on the contractual, on the agreement, the terms that you have. So therefore, you as a TV channel will have to recognize the revenue as and when you display. So for example, the ads are there. So sponsorship is different. I'm keeping
Yeah.
sponsorship, but advertisements which are there, and also nowadays there are on clicks also. Say for example, you are on an app and you click something. So there are sophisticated Google programs who actually, Google monitors this, and directly if it goes to an advertisement site, you on based on your click you generate that amount whatever is as per the contract. And coming back to your question, the ads which are displayed would definitely based on the say period of display, or it is a or the time slot that you've got, that okay, 10 seconds you will get at every time. So therefore based on that, based as and when you have fulfilled your display obligation, revenue will be recognized.
Okay, so the next question is, if an actor goes to Cine and TV Artist Association regarding non-payment of dues, then how does the project or the serial recognizes it and the standards that are applicable in such situations?
So this would be simple. I think so. The main question over here is that he will go only to an association only in case of dispute. Now,
Yeah.
if dispute, the management will have to first, it is the responsibility of the management to assess whether there is going to be any future obligation to make a payment to him. If he has breached the contract, as that example which I gave you, then the management will have to justify that the breach of contract is not at their end, but at the artist's end, or vice versa, that okay, if there were change of law, or because of some events which was beyond the control of the management, it has happened, and the management will not get a future benefit or not liability. But in my view, depending upon how serious the matter is, how material the matter is, and what are the circumstances of the case, either it will be an actual liability of the full amount, or the actual amount liability, that ultimately then what happens is that the settlement takes place. The managements estimate that at what level this liability will be settled, or if it is just a frivolous case and it's not going to be just for harassment and nahi hone wala hai wo liability, then a contingent liability.
So the next question is, on an advertisement for 3 years, the receipts are deferred, and does an auditor need to ensure the expenses are equally deferred? What if the contract is cancelled after 3 years?
So therefore, that would be going on the terms of the contract. And expenses deferral, I don't think so, because the content will be given or provided by the person whose advertisement. Say, for example, today now Tata Motors is advertisement or advertising on NDTV. Then the cost will never come to them, because that content will be provided by either the ad agency or the ad agent of Tata Motors to NDTV. So NDTV will never have a cost. So as and when it will recognize, I mean, that advertisement will come, it will recognize that revenue. And then non-recovery we will go on ECL model. If you have a provision for doubtful debts on that ECL model, it will go.
So my last question is, can you please give some aspects of ESG requirement in such industry?
That is the new thing. Yes. So that's it.
Yeah.
So it's so definitely how much impact because it's not a very power consuming industry, but yes, a lot of travel is involved, etc. So therefore, how you will deal with those, and as of course I have not seen the ESG reports of all these listed companies that they're doing, but maybe it's a good thing that I maybe have to look at it. It's an interesting question. But how much impact that they will have on the environment, how much savings on this thing they will have to that impact will have to be taken. And definitely if it's in the first 1,000 top companies, then that assurance, that reporting also will have to be done.
I thank Mr. Sampath so much for giving us his valuable time. I'd like to invite Anilji to take over from and propose the official vote of
Thank
thanks.
you, sir. Thank you so much, sir. Thank you so much, Manish, sir, for a lovely and very entertaining, very knowledgeable deliberation. We have gained a lot through your deliberation, sir. And apart from having very busy schedule you have given, and as we have discussed, you were busy till last day, and you have given your consent for today. And unfortunately, it was the budget day, but still so many people were there. But we have gained a lot through your deliberation, sir, and hope our moderators have also they are happy facing that they have also gained a lot with your deliberation. Sir, once again, I also propose a formal vote of thanks to you for giving for acceding to our request and sharing your expertise in this sector with all our eminent members. And I also thanks Gaurav Bhatia ji and Gaurav Mani ji for their precious time and sparing their time for to moderate this webinar in a very successful manner, as well as in the question answer session. So thank you so much once again, Manish ji, Gaurav ji, and Gaurav Saini ji. Thank you so much.
Thank you.
Thank you. Namaste.
Thank you, everyone.
Namaste.